Technology stocks are crumbling. Hedge funds are selling tech stocks at the fastest rate in over a decade. Cathie Wood, the penultimate technology investor, is down 48%, and the NASDAQ is down 6% in just the last few months. What the heck is going on with technology stocks, and what might interest rates going up have anything to do with the value or the price of stocks? Today, you're gonna learn all of that and more. Time to think like an investor. Hello and welcome back to the channel, guys. My name is Josh. I'm a certified financial planner and I help hundreds of individuals and families save and invest for retirement. Now, whether you're here because you're a financial advisor who wants to learn how to easily articulate to your clients, or maybe you're an everyday investor who just wants to understand more about stocks and how investing works. Hey, today is all about you guys. We're gonna be talking about what's going on in the markets and what we can really learn from it. But to illustrate this as best as I can, I think I need to tell you guys a story. So I'm 14 years old and I decide I'm gonna learn every single thing I can on investing, and I've Googled a bunch of things. And so I'm walking through the different areas of the library and I find the business section and I find the one book that every single website recommended I read. And yes, you guessed it, or maybe you didn't, but it's called The Intelligent Investor. And I get home from the library and I start to just devour this book. I'm reading everything and I'm absorbing all this great information about what it means to invest in stocks, a lot of psychological tools you can use to be a better investor, and ultimately the techniques behind how people like Warren Buffett invest. What I learned, the big takeaway was I need to be buying stocks below their intrinsic value. And so I thought to myself, okay, that sounds pretty straightforward. You just buy a company for a price that's less than what it's really worth. That sounds like a no-brainer, right? Then the question becomes, well, how do I determine what a company is worth? Well, enter this guy. This is called security analysis. And then, you know, what the Intelligent Investor essentially tells you need to do is you need to go out and buy security analysis and read that one, because that's the one that's actually gonna teach you how to evaluate companies and find out what they're really worth so you can buy them below that. And as I'm sitting here reading this book in my parents' basement, I quickly realized this was not written for like a 14-year-old. And although I thought I was gonna learn how to evaluate companies, all I'm really learning about now is something called discounted cash flows, and I don't really even know what that means. And if you're confused listening to all this, don't worry, you don't need to know any of this for today's video, because I didn't either, and it made no sense to me at all. But ultimately, this book led me to something called WACC, or the weighted average cost of capital. This is what the formula for weighted average cost of capital looks like. So here I am at 14, and I slowly feel this dream of like being a great stock investor slipping away, because I don't really understand any of this stuff. And not only that, I'm actually going out like investing my summer job money in stocks based on some absolute misunderstanding of how valuation works. But a couple years later, I'm sitting in that same position in my parents' basement, and I am just devouring YouTube investing content, kind of like you are right now. Thanks for watching. And I end up coming across a seminar, a video from like a very famous, legendary investment manager. His name is Bill Ackman. And in this video, I wasn't even searching for that topic. He explained discounted cash flow and all these things about valuating companies in the most easy to understand way I've ever heard. So today I want to show you what it was that I learned from all these legendary investors like Bill Ackman in these books, made it click at the foundational level why interest rates are unbelievably important to stock valuations and why tech stocks are being hit unbelievably hard right now. Okay, I've got it. I'm gonna use an analogy, okay? Let's say you're driving along the highway and all of a sudden, boom, your car breaks down and you're stuck in the middle of nowhere and you're like 94% sure you left the stove on. So you're like, oh my God, I need to get home as fast as possible. So what do? You take out your phone and you call your friend Bill. And I already said Bill. My mind subconsciously said Bill because I was just talking about Bill Ackman. You get a hold of your friend Bill and you say, Bill, I'm stuck on the side of the road, I need a ride. And he says, okay, yeah, sure, I can help you out. I'll just be there in a year. And at this point, you're like, Bill, what the a year? How am I supposed to wait a year? I'm stuck right now. So you hang up on Bill because you're kind of pissed. But this illustrates a really important point that relates to investing, okay? An identical service in the future is not worth as much as that identical piece of value now. When we think about the value of something, you have to take into account time. And the reason that makes sense is because if we get some initial boost in our standing in life, we can now grow from this point from a higher base value. So we always want to, given the choice of an identical thing now or in the future, we'd almost always want to take that thing now. I want to show you guys in sketches how this relates to investing, and we're going to make it crystal clear, okay? Let's take a look at this idea of the value of things being different in the present versus the future as it relates to money, right? Okay, let's think of it this way. Over here, we have present you. And present you has $100. Okay, that's pretty straightforward. And so the thing about time and money is that we always would want more money now because we can invest it. We can go earn interest on it, right? This is super basic. Let's think about what $100 is worth in the future. Well, let's say in the market, we can get a guaranteed rate of interest at 2%. So what that means is if we get a guaranteed rate of 2% interest, that means that future value is $102. So it's pretty simple to think about. We have $100 now, but the future value of that $100 is $102 because we can get a guaranteed 2% rate of interest. Okay, therefore, we could do the reverse. What if we have $110 in the future? Somehow, we know whether we own a business or someone promises that they're gonna give us $110 in the future. Well, that's you. Future you in the green has $110. And we know that the going rate of interest is 2%. It's guaranteed. So we do the reverse. What about dividing by 2% to find out the present value of some future cash flow, okay? So the present value of $110 is just 110 divided by 2%. And the present value ends up becoming 107.84. This is how institutional investors and smart investors at the very foundational level think about the time value of money, okay? There is a difference in an identical sum of money in its value now versus the future, okay? Now we come down to something a little trickier, but it's gonna make sense. I promise it will. So here's the deal. What happens if that interest rate goes up? And now you can kind of see where we're going, right? With the current state of things. What happens if that interest rate goes up? Well, now our interest rate's at 5%. So future us has been guaranteed by somebody $110 in the future. But if we divide that by 5%, that is now the new rate of interest, now that interest rates have gone up, our present value is 104.76. We divide it by 5%, and our present value is now way lower than what we had before when the interest rate was 2%. So are you kind of starting to see what's going on here? Some future amount of money is worth less today when interest rates go up because it changes the dynamics of the time value of that money. So now, let's not take a look at, someone offering us 110 in the future. Let's look at maybe a company that is producing money on a guaranteed rate. We have some old legacy business that's just always produced cash flow. And so we think about what the future of that business is. The future income, we know it's gonna give us $100 in the first year. And then the next year after that, it's also gonna pay us another $100. And then the year after that, it's gonna pay us $100 for a total of $300 over the next 3 years. So now this gets a little tricky because we have different time frames. And remember, when Bill left you hanging for a year, that's worth way less than Martha just leaving us hanging for 3 hours. So different time periods require different calculations. This is where it gets a little tricky, but I've got it all written out for us. Let's say the interest rate is 2%, okay? And so what this means is that $100 gets discounted by 2% to give us a value of $98.04 on that first year's profit. Second year's profit now has to be discounted 1 year and then another year. So it gets divided by 2% to the power of 2 because it gets divided by 2% and then by 2%. Same thing with the third year. It gets discounted once and twice and 3 times. And this is the idea of discounting cash flows that was so confusing to me when I first started reading The Intelligent Investor and Security Analysis. But in the reality, so we have 3 years worth of cash flows, we discount that 3 times, and what we have is 3 different future cash flows that we've discounted to its present value. So although we got $300 in total cash flow, that's only worth the sum of these. It's only worth $288.39 today. If you guys are understanding this, give yourself a pat on the back because you're about to understand exactly how interest rates impact tech stocks disproportionately badly. What if we have a company? Are you ready? What if we have a company that isn't paying a lot of money right now, but it's paying us a ton in the future? Think about Tesla. Think about different technology startups. The thing about a startup is it's not producing a lot of money now, but we think it's gonna produce a ton of money in the future. So let's think about that. What if we don't earn any profit in year 1 or any profit in year 2, but we earn all $300 worth of profit in the 3rd year, okay? We still have the same amount, $300 in profit over the 3 years, but now all of that money has to be discounted 3 times, right? So whereas before some of our cash flows were discounted 1 or 2 years, now since it's earnings way out in the future, we're gonna have to discount that whole thing. So we don't have any money on the discounted cash flow from the first 2 years, but now we've discounted that $300 back to $280, $270, and that's our final value. So what you guys can see here now is that the further out the cash flows are, the less valuable it is today. Kind of like a technology company or a startup. The further out we're projecting those cash flows, the less it's really going to be worth. Now, if you combine that with the fact that also increasing these interest rates, if we jack up all these interest rates, that's also gonna decrease the value. So if we have a situation where we have technology companies, which usually don't earn a ton now, but are bound to earn a ton in the future, we're pushing out the cash flows, and these rates are going up, now we have a situation where we're discounting like crazy now that rates are going up. So you're starting to see how interest rates are really impacting technology companies specifically. Therefore, we could think of it this way. When interest rates go down, asset prices go up. And when cash flow, the distance between now and the cash flow goes up further into the future, asset prices also going down. And those are both vice versa. So the reality here is if we have interest rates going up, that hurts asset prices. And it especially hurts those asset prices if we're dealing with businesses that are generating most of their value from some cash or some profit they're gonna generate way out in the future. So if you've stuck with me this whole time, I congratulate you, and that's amazing. And hopefully this illustration and the uses of sketches and these analogies of how I could never find out what discounted cash flow meant and how it's used to value companies and how institutions are probably now selling because they think those stocks are less attractive. Cash flows are further out, interest rates are going up. That means those future cash flows that we use to value a company, that's how the investment industry values a business. These hedge fund managers go, wait a second, discount rates up, cash flows far in the future. People aren't gonna wanna own these stocks that much anymore, so maybe we should sell out of it. So anyways, guys, thank you so much for watching today's video. I hope it gave you a really great way as an advisor at the foundational level to show your clients how interest rates change asset prices, or as an investor, hopefully it gave you an idea of how to value companies. And maybe you can relate to me who you, Siren. If you're an individual investor trying to wrap your mind around valuing companies, kind of like I was, I'm hoping maybe this, turned on a little light bulb that will allow you to think about valuing companies and making more intelligent investment decisions. So anyways, guys, if you enjoyed this video, make sure to hit like, hit subscribe, and turn on post notifications to see more videos just like this one every single week. Until next time.